I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim. Sorry for the sound of the voice, but it's the tail end of a cold.
Well, considering the weather Vancouver's having, the tail end of a typhoon, being a little froggy in the voice.
Yeah. We've got another windstorm and rainstorm coming through tomorrow, apparently, or tonight. But it's old-fashioned type of rain, and I guess things are getting back to normal in Vancouver.
But the markets, are they behaving normally right now?
You know, there was a time when you had a normal business cycle and a normal stock market cycle, and we used to call it the cycle for share certificates. And then you would have the stock market going up, and then it would start down. But that was usually about 11 or 12 months before the economy rolled over. So then you had the fund managers looking at a stock market that's beginning to underperform, but they're looking at the economy. Oh, this is good, we'll stay long. And then the next thing on that old cycle was that all of a sudden you had stocks and the economy going down at the same time. So then they found a reason then to sell after the highs. So, and then I guess in the 2000 and 2007, the rationale for staying long when credit markets were changing, and there's always an obvious strain in the credit markets as speculation blows out. So what you had then was that as the markets began to falter in 2000, the rationale for staying in was that the Fed was going to cut interest rates, which they would do, of course, with perfect timing. And then, but, you know, if you just take even just 200 years of history and look at the business cycle and look at interest rates, well, damn me if interest rates don't go up in a boom and down in the bust. So the streets got all wired up about the Fed was going to cut interest rates and you could stay long. Well, in 2000 and 2007, that turned out to be bad policy because the stock market went down and interest rates fell to zero. But there's a new reason to stay long now, and it has nothing to do with the interest rates. It's the Fed and other central banks will continue to buy assets. Now, I think that gives new meaning to the greater fool theory that there's always going to be somebody after you've bought to buy it, whatever it is, and take it higher. And because they're in quasi-government agencies, central banks, that really does make them greater fools indeed. So here we are. Now what's going on in the credit markets? Well, they're coming under a little strain. You've had the yield curve take a turn to steepening, check back, and then it's now working on making a more serious move to steepening. This would help the bank stocks initially because the spreads are going their way, but when you've been in a bubble, further changes in the yield curve then become damaging, and it's the change that does it. And then also on credit spreads, which is the difference between high-grade and low-grade yields, out of the panic in January a year ago, you've had just a fabulous rush to narrowing of credit spreads, which shows a lot of confidence. Everybody's quite sure that the party will keep going. And, I guess maybe about 3 months ago or so, we put on a target that on this kind of a move in narrowing spreads, it could go into an RSI, that's the momentum of 25. And last week it got into 24.5. So reached the target, slightly exceeded it. So then what you have here now is the full intensity of speculation is quite likely in the market. And then you're going to have to watch and see. Maybe it might take a week or so before it reverses. And that would be a problem in the financial markets. It's as I said, the street really likes to have the comfort of an agency that's going to protect them. And as I said, originally it was that the Fed would do the magical cut in interest rates, and then now it's that they will continue to buy assets. Now, I don't think that that's going to work out. You've seen terrific excesses, and then to look at the broad market in New York, we look at the NYSE composite, which is virtually all of the stocks, and it's under the symbol NYA, and it's had the rally that we expected coming out of the problems of January, and then suffered with the Brexit exit thing, and then of course a whole lot of central bankers, not the Fed, were buying like crazy and giving it up. So but what we're looking at here is the NYA, the broad market, did not make new highs. The senior indexes such as the Dow and the S&P and the NASDAQ did make new highs, mainly because the central banks that are buying stocks would be buying the big cap stocks, so they're in the S&P 500. So, anyways, you had speculative excesses in the base metal mining stocks. You had speculative excesses in the utilities. You had them in gold stocks in the summer, and we labeled all of those as they came in, and they're off quite smartly. Now, the latest one that we have been watching that's now up to frothy and beginning to generate some technical excesses are the coal stocks in the States. KOL is the symbol for one ETF, and it's up there, and it's registering, as I say, technical excesses. It could take a week or so before it rolls over, and then the stock market are vulnerable just based on the technical excesses reached. Now, one other backup that we have on this is what worked for us in 2015 was that the first time we ever used it, we relied on the old Dow theory, and it was non-confirming the advance in the Dow with the transports, and that really, transports really failed in May, so that then said that the bull market was over. And here we have now the transports did not go to new highs, confirming a bull market for the Dow and the S&P, and it's beginning to weaken a little here now. I mean, it rallied, but we're looking at it on the old Dow theory, and it's saying, watch out. And so excesses came in. Excesses can be measured, and then you have the patience for it to roll over. Fund managers on the excesses as these are clocked just should be lightening up. I mean, you don't have, you can't, a big fund can't sell once you're past the top. It's very difficult. And the theme would be sell the rallies and not the bull market, buy the dips. So then, I guess one other sector that was really, really good for us was the precious metal sector. And in November, we wrote a piece sort of saying long-term stuff. This is what we need end the bear market in precious metal stocks and to begin a new cyclical bull market. And we also wrote, that was in November, that hopefully this would be completed by around Christmas or into January. And it was. We got the right stuff, and then, as we say in history, you got the old Hoye index of senior gold stocks rallied from 99 to 286. So that kind of energy, enthusiasm, speculation, registered, I think it was in July, late July, all these technical excesses, and we advised that this correction in the precious metal sector would be significant, and then once it broke, and then we were able then to put a target on the price decline in the gold stocks, and it was 20% plus would be a nice round target, and that might have been accomplished by late September. And then, I guess a week before the end of September, we noted that the precious metal sector could weaken further, and I think Huey was down something like 30%, so nice move to avoid. But again, this is a very dangerous market, and if we go into a credit crisis, say before the end of the year, that would increase the investment demand for gold because it happens to be a liquid item. And also it would increase, the investment demand for the U.S. dollar because T-bills are the other very liquid item. And when it's scary time, the customers just look to have liquidity in and out, forget about trying to make money. So we don't see people making much money on the increase in investment demand for gold, mainly because it would be associated with a firmer dollar. But we do see that the cost of mining gold has been improving for the gold miners. That's where you get the increase in the real price of gold relative to, for example, the producer price index. And that's been increasing since, I think it was December. And the latest post, I think, was August, but it had popped up nicely above a trading level. So gold's real price is acting well, and that suggests that profitability will be coming back into the industry, which is very constructive. Now, of all of the industries and commerce that exist out there, there's many different kinds, there's only one that you can actually rationally analyze as being the best moneymaker in a post-bubble contraction, and it's always been gold, the gold sector. So where the base metal miners have been hit with base metal prices faltering and heading down, the gold stocks have been hit mainly because they were too speculative. But they have hope that the real price will continue up, and that's our conclusion, that the gold sector is in a cyclical bull market, and this is the first significant correction. And, of course, the tools that measured the excess in the summer, they work opposite, and they're very good at picking the lows as you go into a correction, or as a correction completes. And we would be looking for downside capitulations, and the other one would be perhaps even a springboard buy. And then those are sort of momentum things, but the other one we've got has to do with pattern, and that's what in this case would be called a sequential buy for the sector when it comes in. And at the moment, we're not sure when that's going to come in, so it's a bit of a mystery, but we do know that the opportunity is coming.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Bob Hoye. Bob, politics everywhere, of course, in the U.S. right now with the presidential election just around the corner. Elizabeth Warren, Democratic senator, wants to have Mary Jo White, the chair of the Securities and Exchange Commission, fired because she won't bring in a rule that forces corporations to reveal who they're donating money to for this election. And this follows the U.S. Supreme Court in 2010 saying corporations have no limit on how much they can contribute. However, they don't have to tell you how much they gave, say, Donald Trump or Hillary.
Oh, yeah, well, Warren, she's very radical left and a control freak of the first order. They just want to control everything. Well, as a matter of fact, the way the campaign is going in the States is that it's not so much that the Democrats and their tame media are trying to debate Trump. They want to destroy him, absolutely destroy him. It is no holds barred. And if you look at how tough Obama had to be in order to beat the Clinton machine, no, that was something. And so you have to have something very tough at this time to beat the Clinton machine. And but it's not just the Clinton machine that has to be taken on. It is the whole apparatus of the media. It's really quite alarming where the media has used to be what they called the fourth estate and was there to criticize policy and proposals and keep government towing the line. But it's not the case. In the U.S. now, the mainstream media is supporting the Democrats. The Internal Revenue System, the tax authority, is supporting the Democrats. The Supreme Court is very close to being in a position to support the Democrats. And then, of course, you've seen the tragedy of the corruption of Comey at the FBI. It's scary, and it's aiming to have a one-party system. I mean, why go, when you got the control, why go through the turmoil of having an election? Let's just have control and keep it. So this, I believe, is a very important election, and if Hillary gets in, I think there'll be repercussions, and then there'll be the midterm elections a couple of years from now, and then the wrath of the dissatisfied people would become visible. You've got to look back to the last popular uprising, which was in the late 80s in Eastern Europe, and it was against their communist masters, and they looked at how well the governing classes were living, looked at the promises from the governing classes, and then looked at how little was getting down to them, and a popular uprising threw over a murderous police state. Very exciting stuff. Now, in the U.S., I've been describing this as another popular uprising for the same reasons. The governing classes are living extremely well and with huge corruption. And for at least 20 years, the net take-home pay of ordinary people has not advanced one bit, and the money is going into all the government good life. So it is a genuine popular uprising, and as nasty as it is, they've certainly provoked Trump. But if we look at the last federal election in Canada, where the liberal media had vilified Harper, and all he was trying to do was bring in, reintroduce the concept of limited government. And so they vilified him, and Harper was polite. So even if Trump was not as rough as he is, the condemnation would be just as severe. And if you recall back to the Reagan election year, the first one in 1980, as he was advancing in the primaries, the leftist media was going berserk. He was the cowboy who was put his hand on the finger of the bomb and scorched the earth. And of course, what you have with Trump is he doesn't believe in man-caused global warming, and he, by not believing in it, that's going to scorch the earth too. So there's some interesting parallels. So they ended up calling Reagan the Teflon candidate and then the Teflon president, because they were throwing the same stuff at him that they're throwing at Trump, and it didn't stick. It just came right off. So the next month in global politics is going to be very interesting.
Bob, I know you're struggling with a cold. Thanks so much for chatting with us.
Well, thank you, Jim. Good to be with you, and we'll look forward to having better health and a better voice next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.